Hi there, good afternoon. You've tuned into ET now, and this is Market Fatafat with me, Cheryl D'Souza. Along with me, I have Shri Sharma. Very good afternoon to you, Shri. And looks like it's a good day coming in, at least for the Indian benchmark indices, because if you look at the way how we're trending, it's only one way, and that is upwards. If you look at the markets, at one point in time, the Nifty actually surpassed 19,800 mark. Now we're a tad bit below those levels, but nevertheless holding on to good gains as of now. If you look at the Sensex also moving in tandem with the benchmark indices. But let's talk about NMDC, and that particular counter is in focus. We are joined by Amitava Mukherjee, who is the chairman and managing director, additional charge of NMDC. A very good afternoon to you, sir. Thank you so much for joining us on ET now. And firstly, let me dive into the commodity prices then. We're seeing buoyant international iron ore prices. If you could tell us, how are the domestic prices trending right now? And also, is there any case for increasing the prices, as your last price increase was in the month of October? If you could also elaborate, is there any reason for difference between the domestic as well as the export prices?
Yeah, but there has been a spurt in the international prices, but historically, because of the duty structure where we have 30% export duty on exports, so historically, if you see our at least our prices in the East Coast is at least at around 40% discount as compared to the international prices. So when we calculate our net domestic realization, that is after the 30% export duty and then around $20 for taking it to the port, and then around 20% for our royalty, DMF, etc. The net export realization is still almost at par or even less than our net domestic realization. So to that extent, yes, the Indian ore has always been cheaper than the international prices. That's been the historical truth, and that is the same here as well. Right now, it is almost at par, slightly lower than the net domestic net export realization.
Good afternoon, Mr. Mukherjee. This is Shri also joining in. My question is, any more headroom in the international price rise is that you foresee, or do you see the iron pricing peaking out and expect a fall in the iron ore prices in FY24? What's the outlook?
No, I don't see that it has picked up because I believe there is some headroom that we are exploring, whether there is a headroom to increase the prices or not. The international prices are only one of the variables that need to be considered while we do pricing. The domestic steel prices, the cost of logistics, the overall demand scenario that we all have. There are multiple variable factors that we look into while taking a call on pricing. But I do believe that it has not peaked out, and there might be some headroom for upward revision. I don't see them going down, at least in the short term. I don't think there will be much scope for reduction. Yes, we are looking at the headroom. We'll take a call sooner than later.
So owing to that, Mr. Mukherjee, what's your outlook coming in for the margins going ahead? And also, if I could add to that, when can we actually expect to see your margins in the range of 40% or so, as we previously seen the NMDC margins around that range?
If you're talking in terms of EBITDA, yes, the EBITDA will now be around at the range of around 40%, 40-41% for the current financial year. That's because if you see the taxes and duty structure, straight away 45% goes to the government straight away. So because there is around the DMF royalties around 20% and another 22.5% for what is called the additional royalty that we have to pay as a government company. And then there is this forest fees, etc., etc. So they account for another 2.5%. So around 45% is taxes and duties. So that leaves us 55%. Even if we take around 12 to 13% cost of production, then we would be having an EBITDA of around somewhere around 40-41% for the current year. So, and that would be almost there for the next year as well. Slightly, maybe a percentage or 2% on the upper side or the lower side. But this year we are looking at an EBITDA of around 40-41%. Net of taxes, that should be around around 30 to 31%.
Lastly, Mr. Mukherjee, wanted to ask you on the capex, because last decade you have invested around 18,000 crores in steel plant. But for the next decade, what do you plan to do with the cash generation, considering that you are debt free now, and where will the cash get deployed in?
Oh, we have a huge investment plan in terms of ramping up our infrastructure. A lot of money will be consumed in ramping up our infrastructure for marketing, actually, in terms of blending yards, in terms of other dispatch capacity augmentation like slurry pipeline, etc. We are doing a deep market study of what the market would require in the next 5 years, 10 years, 15 years, and then we accordingly we are planning to make our investment accordingly. The ballpark figure, of course, that's not a current figure as of now. Should I think the marketing infrastructure alone would require around 25,000 to 30,000 crores in the next 4 to 5 years. Now that's a ballpark figure. And on the production side, it will require another 5 to 10,000 figures to wrap up our production to about 100 million ton in after FY30. So we are making this master plan. I hope the investment proposals will be able to get them sanctioned by the next financial year. And we should be able to set the ball rolling. So between FY25 and FY30, I think anything between 30,000 to 40,000 crores would be required for the our master plan, our dream of getting to about 100 million ton. So we have a lot of investment that needs to be made in our existing mining business as well.
With this, we'll let you go on that, Mr. Mukherjee. Thank you so much for giving all your time to ET Now and helping with the outlook for NMDC going ahead. So that was the management sharing that the margins are expected to go in the range of 40 to 45% in the times ahead, and also shared his outlook on the pricing. But with this, viewers, let's move on. And in this edition of Market Fatafat, let's kickstart highlighting all the stocks that are in the news in the back of the news flow, or they are in focus on the back of the technicals. And with this, let me welcome on board our team of researchers. Today, Vamakshi as well as Ankita are joining us from the research side, and on technicals, Konar Botra as always. So let's get started. And the first stock that we wish to highlight today is from the hotel space, two counters particularly, Indian Hotels as well as Lemon Tree, because Motilal Oswal has come out with quite a positive note on the hotel counters, where they are saying that the quarter gone by has been quite robust for all these hotel companies. But not just that, the second half of FY24 is looking even more better in terms of the marriage season that is expected to kick in soon. They are poised for a growth on the favorable demand outlook led by the rising average room rate. And not just that, they are seeing huge events like the wedding season, the World Cup just got done. So all of that in terms of the foreign tourist arrivals should boost the demand in the second half of FY24. They reiterate their buy rating on Indian Hotels with a target price of 480 rupees. So that's the second straight day on Indian Hotels where we are seeing a positive brokerage note coming in, because just yesterday UBS came out with its reports. Target price close to 500 rupees. Now Motilal Oswal is targeting 480 on that. And the other counter on Motilal Oswal's radar is Lemon Tree Hotels, where they maintain a buy rating on this one as well, and the target price of 135 rupees for FY25. So on the back of this report, both these hotel counters are in focus.
All right, next up, let's put the spotlight then on Adani Enterprises. Remember, yesterday the stock was near its, was actually trading with good gains today as well. If you look at the stock price, it's trading higher by about 2.7%, among the top gainers on the Nifty today. And the reason being is that the company has been in, they've actually, their step-down subsidiary, Mumbai Travel Retail, was incorporated in its wholly owned subsidiary, that is MTRPL Macau. What the company has said that the company has been incorporated for bidding for duty-free liquor and tobacco products at Macau International Airport. Remember that Mumbai Travel Retail holds about 100% of the share capital of MTRPL Macau and has an authorized capital of across approximately 2.5 lakh rupees. The registration process for MML was completed on November 20th, is what Adani Enterprises informed in their stock exchange filing. And the new company adds to Adani Group's diverse portfolio, is what the company mentioned in its filing. And post that particular development, as you can see it on your screen, the stock is trading with good gains, approximately 2.7% as we speak.
Okay, but another counter seen to be gaining is SBI Life, and not just that, all the life insurance companies are showing good moves. But specifically, what are you spotting for SBI Life, Kunal?
So many of the insurance stocks, of course, are looking attractive. SBI Life is managing to come back into a breakout mode. The stock has confirmed a breakout on the weekly charts of a bullish flag formation, breaking past about the levels of 1355, 1360, I think last week or in the last couple of days, as well as now breaking past about the 1400 levels quite comfortably. So I believe that that's a clear sign of a breakout as well as a start of a new trend for this insurance stock. And I believe that from here on, we could be looking at a major multi-month rally for many of the insurance names, including SBI Life.
All right, moving on then. Vamakshi, let's talk about IFGL refractories and why is this particular counter in focus today?
Well, Cheryl, this counter is in focus on the back of a brokerage note that came in from Dalal and Brocha. They've initiated coverage in this counter and have given a buy on dips recommendation on this stock, target price of 786 rupees per share. Largely, they believe that the company has emerged as a robust contender in the specialized refractories market. The company boasts of a market share of almost 6% in the overall Indian refractory industry, and they also have an impressive 15% share in the Indian flow control industry. The management has outlined ambitious plans for the company going ahead, and in fact they're aiming to double the revenue from FY21 to FY26. The peer company is also definitely they're commanding higher valuations, mainly on account of their MNC status and marginally better return ratios, but they do believe that IFGL offers a margin of safety that is merited by its past and expected operational performance. They believe that our IFGL could sustain its robust performance, and if that does happen, the valuation seems quite reasonable when we compare it to some of its peers. Considering the recent rally that the stock has seen, they've initiated coverage with a buy on dips recommendation, target price of 786 rupees per share. On the back of that, IFGL refractories in focus today.
Okay, but moving on, and one such stock, Kunal, that has seen no stopping is MFSL at a 52-week high level and very close to its all-time high level. So do you believe that all-time high is achievable in the short term?
Well, yeah, looking at the breakout, looking at the momentum over the last 3 months, specifically for the stock price, 3 quarters over the last for the stock from I think 600 or 650 levels, where the rally started off for Max Financial Services, to now 980 plus levels where the stock is trading. So MFSL is something which on the short term as well as on the medium term charts look very attractive. The stock has confirmed a breakout of a swing resistance, which was I think around 950, 940 mark for the stock price today. And I think that's one of the major reasons for picking up the stock. Would expect that the stock would come back to the 1140 mark, which was the all-time high levels for MFSL.
All right, moving on, Ankita, not one but 2 stocks on your radar. That one is Karnataka Bank and the other one is HDFC Life. Both of them in focus on back of same news flow.
Absolutely, Cheryl. Both of them are, in fact, they have partnered together. They formed a corporate alliance, the Karnataka Bank with HDFC Life Insurance, to distribute life insurance products. Now, this collaboration aims to provide Karnataka Bank's customers a range of financial solutions by leveraging the bank's experience and HDFC Life's expertise in life insurance. Now, the partnership focuses on delivering benefits related to financial security and life protection to its customers. And on the back of that news flow, these stocks are in focus. In fact, HDFC Life is up a good 2% in trade today.
Okay, so that's why both of these counters are in focus. But with this, it's time to slip into a very short break in this edition of Market Fatafat. Don't go anywhere. We'll be right back.